I'd like to introduce the first speaker, Mrs. Daniela Corsini, who is connected remotely. Good morning. Good morning, everyone. She got a cum laude degree in statistical economics and social sciences at the Bocconi University. She started in 2006 in Luxembourg. As a portfolio manager, she's in charge of equity funds in emerging markets. In 2011, she became a member of the Research Institute of the Intesa San Paolo Bank, managing the commodity markets, energy, agriculture, industry, and precious metals. Since 2011, she is a member of the CFA Institute. She is going to speak about a very topical subject. She speaks about the transition to a post-pandemic world, really a burning issue. Thank you very much. You have the floor. Thank you very much for what you did and all the participants devoting your time. I have some slides. I hope I can share the screen. Otherwise, I ask the engineers. I'm sorry, the screen sharing does not work. Anyway, during the pandemic, we had an unprecedented shock in the world market of raw materials, and gold in particular. The demand for gold in 2020 dropped by 16%, with a dramatic drop for the demand for jewels. Central banks had temporarily set aside the objective of diversifying resources and concentrated their resources in the monetary policy to expand and support the economy affected by the pandemic. The only gold demand which dramatically increased was in the financial sector. There was an increase in ingots and coins and ETFs, so financial funds based on gold. This contribution to the world demand doubled during that year and was 24% of the total demand for gold, which indeed had a major impact. In 2021, thanks to the announcement of new vaccines, thanks to the economic recovery, the world gold demand normalized. This has not yet been accomplished, but still there was a 52% increase in jewels demand at world level, plus 93% in India and 83% in China, the countries more affected by the pandemic and by the lockdown measures to contain contaminations. Technology demand was plus 9%, and demand of central banks plus 82%. Opposed to this very robust growth, the financial demand of ETFs dropped. And ETFs contribution was minus 4% of world demand, as opposed to the 24% of the previous year. As for the price of gold, the volumes of gold in the hands of ETFs, the correlation is very good and significant. Quotations increased in line with the accumulation of gold by ETFs. This correlation dates back long ago. Already in 2019, with very expansive monetary policy, there was a first increase in gold, guided by the accumulation in ETFs. This push for the demand of shelter goods continued in 2020, and stabilized between 2020 and 21 when it began to drop. With the war of Ukraine, the demand for shelter goods or safe havens continued to be key. That indeed brought to an accumulation of ETFs who bought more gold than in the past because the financial market was asking for safe goods, and the quotations of gold followed suit. The financial demand will be the main driver for gold quotation also this year. As I told you, the normalization process is nearly accomplished in terms of volumes consumed in jewelry. We are back to the before COVID. In some cases, demand is higher than the pre-COVID time. The real driver will be the financial markets will make the difference. The main topics will be connected to war and inflation. In the first months of this year, gold quotations increase was accompanied by fear of risk. The correlation was very significant with a fear of risk and price of gold. And volatility in the financial market jumped. In 2022, there has been a major increase in the price of gold, followed by an increased volatility in financial markets. On the contrary, other traditional drivers of financial demand for gold, such as American dollar or more restrictive monetary policies, are no longer so important. This is so, but for the demand for safeguards was the main driver. The American dollar is considered a shelter, so when panic is there, gold dollar went up, which happened in these first months. In conditions of less tensions, the correlation between the two is negative. So when the dollar goes up, usually the gold goes down. This has not happened, and it might not happen in the coming months, notwithstanding the increase in the dollar. For today, the main issue is the search for protection. As for the yields on interest rates, mainly in the US, there was an increase, and the Federal Reserve Bank this year announced a first increase in the interest rates, which probably will start the trend upward of the American monetary policy, which is explained by the willingness to contain and avoid overheating the economy. Usually gold at the beginning of a restriction cycles, its value goes down. This has not happened. So we think that the increased interest rates will have a lower impact as compared with the past, because there are more geopolitical concerns and the inflation will remain a problem. We don't think that central banks will increase rates so much to damage the value of gold. Real rates will remain negative for a long time, even though nominal rates will continue to grow. And for that reason, gold will continue to be supported by monetary policies, notwithstanding this restrictive approach by the Federal Bank. As for price forecasts, gold is vulnerable to high prices. It might be beyond $2,200 per ounce in the event geopolitics gets worse, especially in Ukraine, and then in the following quarter might range between 2,000 to 1,090. Average price for 2023, $950 per ounce. Silver will follow. The correlation with gold is very strong, even though the fundamentals of silver are stronger, thanks to the possibility to use talco in the future with an overperformance of silver in the long term. That will not be the case in the short term, so we hope to remain between $22 to $30 per ounce. In 2023, 25 US dollars will be the average price in line with the present market. Metal, platinum and palladium prices are different. The demand from the automotive sector is the key issue, together with geopolitical risks, in particular for palladium, which is produced in Russia by 40% of the mine production in the world. Second producer is South Africa, 40%. 85% then, the world demand for palladium comes from the automotive sector, so quotations will continue to fluctuate depending on the concerns for Russia or recovery for the automotive sector, which is now limited by the lack of chips. And probably for this metal, we foresee between 2,500 and 3,200, and the average $2,650 per ounce. Platinum, considering it that Russia is less exposed and automotive is not really relevant in this demand, it is 20% of world demand. Jewelry has a weight, 15% of world demand, and for investment, 9% in 2020. So platinum will be more correlated with gold in the coming months. We do expect between $950, $1,350 per ounce, an average of $1,200 ounce for 2023. The floor to the colleagues of the Research Institute. Thank you.